Good morning. Welcome to our Ashworth Wealth Weekly Market Update. My name is Scott Thomas. I came across a chart earlier this week that I wanted to share with you this morning. It's a pretty simple chart, but I think there's a lot of things to be learned from this chart. And I wanted to kind of go through this and kind of explain what this means. So the chart is a chart of personal savings rates. And what it is it's a 5-year average of personal savings rates of Americans from pre-pandemic to post-pandemic. And this is a 5-year average. The blue number is what was initially reported as consumer saving. The purple number is what it was revised to once they had a chance to really look at the numbers. So as we look back from 2005 or 2015 to 2019, the consumer savings rate in this country was about 6.1%. When we go ahead to post-pandemic and we look at the 2024 number, that number came out at 3.4 initially and then was revised up to 5.2. Now that may not seem like a big deal, but let's kind of walk through that and talk about that. The 3.4% represents the lowest savings rate by Americans that we've ever seen. What that meant was most economists looked at that and said, well, if savings rates are down that low, that indicates that there will probably be a slowdown in spending. Consumer spending has continued to be strong. That's what's buoyed up the economy. And if savings rates are that low, that usually is a sign that spending is going to go down. And that obviously affects a lot of things in the economy. When that number was revised up to 5.2, even though we're not back up to the pre-pandemic levels, that's a much better indicator of where things are at. And most economists feel like that we are in better shape than we thought we were when that number came in at 3.4. So let me kind of talk about that, and we'll talk about a couple other things that affects. So again, it looks like that consumers look healthier and our financial situation looks healthier than what we thought. However, there still is some underneath the surface. There's a couple of things we need to take a look at. Rising wealth has supported strong spending in higher income people. However, lower income households continue to have a lot of pressure. And so that is something that we're going to continue to watch very closely. Those are the people that have been the most affected. But there are some other positive news out there. We are right in the middle of a 17 straight month year over year real wage gain. What that means is when inflation goes so high, it is really hard for wages to keep up with inflation when inflation hits us as fast and as hard as it did here a couple of years ago. So what we're seeing now is over the last 17 months in a row, we've seen real job growth be higher than what inflation is. So that is a very good sign that we're kind of catching up to where inflation hit us really hard. Wages are catching up to where inflation is. So what does this all mean? Well, it looks like the economy is more resilient than many people thought, and that should support continued earnings. It should support the economy to continue to grow, stocks continue to grow, even though we don't see big changes or big gains coming in the next little bit. It does look like we would have a softer landing if we go into some kind of a slowdown, or we will continue to, the markets will continue to grind upwards. So it's a very good indicator that things are in better shape than we thought they were. Okay, so what does that mean for the interest rates? The Fed meets again on November 6th and 7th, and it's expected that there will be another quarter to maybe even a half a point reduction in interest rates. We hope that's the case. That remains to be seen, but that's coming up here in the next couple of weeks. A couple other numbers that we followed. Let me share a couple things with you. We have followed inflation obviously very, very closely, and inflation is expected to be about 3.1% in 2024. And in 2025, the projection is 1.8% inflation. If those numbers hold true, and it looks like as of right now they do, that allows the Federal Reserve to come in and cut rates. So I would not be surprised to see those rates cut in November. That remains to be seen, and we'll see what happens on that. And we'll watch that very closely. Again, we're grateful that you join us for these weekly market updates. And again, we encourage questions. We get some really good questions that people email in or as we're in our meetings that they ask us about. And we would certainly encourage that. And we appreciate you joining us each week for this. Thank you.